let's start with that surprise bang up U.S. payrolls report. Surge to jobless rate hits 53-year low. Yes, well, we know that this is going to be revised, but the report raises doubts about the looming recession. So you're probably hearing things like, well, maybe there won't be a recession this time, even though our yield curve has now remained inverted for a very long time. And globally, I think it was last November, the global yield curve inverted. But they always say it, this time is different. Actually, what makes this time different? It's the end of the currency's life cycle. And what was the reaction to the markets? Well, Treasury yields jumped. Why? Because that means that the Fed cannot slow down. I mean, if it stays to its mission anyway, it cannot slow down raising rates. In fact, the more people that are out there working, in theory, the more spending that's happening, and that stokes inflation. So, of course, interest rates are going to spike up. But, have you asked yourself, gee, what other surprises might lie ahead for us? And before we go there, I just want to point something out. This is the labor force participation rate. And frankly, you have to go all the way back to the 70s to get this level of participation, well off the participation in the 90s. And the 70s, when we went off the gold standard, forced more women particularly into the workforce. Because prior to that, salary of $9,500, that was the average wage, could support a family of four. What would happen to a family of four if you were only taking in $9,500 a year now? So I think it's really interesting that we have basically come full circle. But what was happening then? We were shifting the monetary system, and that is exactly what's happening today. And in the meantime, as the Fed raises rates, it's about to curb hiring. They want more people unemployed. And one of the things that they also definitely want is they do not want the workers to have control and be able to demand more wages. Okay, for CEOs to do that, but not the average worker. So what we've been watching in the markets is, particularly on the NASDAQ, growth slows at three of tech's biggest names, Apple, Amazon, Alphabet, and so they're laying off people. But there's a whole host of tech companies that are also laying off workers. And remember, when the Fed puts in a policy measure, it takes 12 to 18 months to work through the system until they know, did they get what they had intended to get? We're about to find out, because it hasn't been, it's just been like roughly a year. But as inflation rises, sales slow, layoffs rise. Be careful of what you wish for, because I think it's going to be way worse than what anybody's anticipating. And they definitely do not want you to know about this. So those hottest sectors of the reopening are now driving a wage slowdown that you really aren't seeing, because there's a whole list of companies that go into that. But leisure, hospitality, education, and health services, professional business services, retail and transportation and warehousing, those 5 categories have now come sharply off the boil, and you can see these wages decline. The rest of them are kind of staying static, going up a little bit, so it's really covering the deterioration that is happening underneath the markets. Of course, there's an argument to be made that wage growth specifically is going in the direction the policymakers would like to see. But also it's the slowing, because once you give somebody a raise, how easy is that to take back? However, and this was always the plan from 1913 forward, if you could make that raise spend like a wage cut, right? So that $9,500 a year income that supported a family of 4 with one wage earner. Now it's something like $67,000 a year. But you got to have at least 2 wage earners and you're paycheck to paycheck. You see the illusion? Let this illusion unravel for you so that you can see the truth. If you like this clip and you want to watch the full video, just click right here. And to subscribe, click right here.